Hi everybody, thank you all for joining in. Okay, so there is a good question that has come up. Is it a good time to start a Vriddhi small cap PMS? Okay, so I'll link this back to the valuations that are there for the Indian market. Okay, so now I think there's a good question to sort of start with. So India's valuation has come down. The premium that you're paying for investing in India has drastically come off over the last 1 year. This is 1 year's data, so we are drastically come off. So that is one thing. In terms of mid, small, and large, of course, from a uncertainty and managing volatility perspective, your large is better. This time around, we have seen that the large caps also are on par in terms of volatility with the small and mid caps. Given that today how things stand, it is a good time to start Vriddhi, but you should definitely have a 7 to 10 year sort of a expectation in terms of horizon. Right. For any PMS strategy that you look to invest in, whether it is with us or whether it is with anybody else, right? Because you need to let the strategy play out. You need to let active management sort of evolve over the next 1.5 years. And only then they are able to position themselves in such a way that 2030, 2031, where the growth in India is expected to become better and get high, that is where you will be able to benefit of it. So yes, it is a good starting point for Vriddhi, but definitely you will have to participate on volatility, particularly for Vriddhi, so that they are able to buy very high conviction small cap ideas as and when that opportunity presents itself. Right, but it is a good time to start off on small cap. So how are we positioned on Neo, right? So let me take up Neo also now since this question has come. Neo predominantly is doing more of large cap investing, right? We've run a flexible mandate. So we have 0 to 100 sort of mandate on all asset classes, right? So we can go from having 100% equity to 100% debt to 100% precious metals to 100% global also. We are open to take stocks and ETFs as well. Right. So it is open, right? So it is a basket sort of approach that takes care of 360-degree investing. Okay. So how are we positioned on the equity part? On the equity part, we're almost 80-85% going straight into large caps, right? We are very conservative as managers for Neo when it comes to buying something into small and mid cap, right? There should be a good amount of valuation comfort. So we look at it always from a range: fair, cheap, very cheap; fair, expensive, very expensive. Okay. So when that comes into cheap and cheaper, right? So for smalls, we would definitely prefer to take it at cheaper ranges. That's when we start initiating positions, right? To give you a sense, we have started to take some amount of small cap exposure, that is additional small cap exposure that has come up on Neo. Okay, so there are opportunities that are presenting to us, and we are also taking cognizance of that and participating in it. Okay, now India is a good time for investors to start looking at, because India in that range of fair, cheap, very cheap, fair, expensive, very expensive. 1 year back was somewhere around fair. Now it is somewhere around cheap. Okay, so it is a good time for India, for anyone to invest in India. Why? You have a lot of reforms that have come. The government has been extremely proactive, both on the fiscal side and on the monetary side, to make sure that one, the rates are getting cut. Second, to make sure that GST again is getting rationalized, and income tax benefits also are being given, plus eighth pay commission coming. So everything here comes more from a let's be proactive from that sense. And with all these war related issues that are there, India has a lot of shock absorbers in place. Right. So we were at a $80 sort of a per barrel sort of threshold for oil. And given how our macro has improved over the last 5 years, that number has gone to $90. Right. So everybody in the world, any country would face energy shocks because of this entire war. But how do you sort of protect? India has that shock absorber currently, right? So how do you invest the sold properties cash money? See, you have to sit with your auditor, right? So you have to reinvest those proceeds back to NRO or NRE, wherever you get that money, and that money has to be put here in India. So that is how you will go about doing it. If you have to check in terms of some sort of tax benefits in India, you will get. I mean, because of the double tax agreement, Singapore investors will definitely get some advantage in when you look at investing in India. Right. Okay. Hi, I'm an NRI. My India investment in the future. I recently saw my property in India and thinking of investing in it, but how the rupee is losing concern. And my understanding is that it will affect when I want to take the money to the country that I live. Okay. Now, because you're outside and the dollar, particularly for, let me take that part. Okay, perfect. Right. So for you, right, you're able to get more Indian rupees now if you put money now. So we are in a situation that is actually beneficial for all the non-resident Indians, because one, for years, right, between 2021 and 2024, 4, our depreciation was not at a very high pace, right? So we were appreciating compared to other currencies, and 25 onwards there has been a normalization that has taken place, and a lot of speculation has come in this particular year because of the war. Right. So usually in these cases, what happens is you're able to get more units when you transfer it back to INR. That is one. Second, because the valuations also have come off significantly. So two benefits you're able to get. One, you're able to get more of the money that you put here, and second, you're able to buy more also of the of something that is cheap, which will ultimately sort of benefit you in the future when that recovery starts taking place. Because here we are looking to buy only high quality and cheaper assets, right? So that risk is definitely there, but given how we are today, you're able to get more for your buck. Right. That issue would have been there because that issue would have been there if, we were in that case where rupee was a little bit more stronger and rupee was a bit more expensive. So it was considered that rupee was expensive a year and a half back. But today, given how things are, it has come back to its sort of fair value and it's below fair itself, right? So you're getting more for your buck and you're able to buy assets also, which are cheap. So again, that is more for your buck. Right. So that is a big risk that I definitely must tell you. So when we consider it, we only consider it from this angle. Right. So when we reach out to our investors who are non-resident Indians, we make them understand that the benefits of particular periods that come to you, when Indian markets presents itself, and that should definitely be taken advantage of. Right. So that is one thing. Right. What do we think about rupee appreciating? See, given how we are actually from a macroeconomic standpoint, we are very strong, and we are expecting that we should not depreciate as much as what we used to from a 3 to 4% sort of per annum sort of declines. Should appreciate somewhere between the pace of depreciation should definitely be slower, right? And Singapore again is a very strong currency. So India has to be that one market where you try to put more money when you are able to get more for your buck and when valuations are extremely cheap. It is come to cheap, right? Use it only for that. Okay. In terms of again, if you talk about valuation perspective, your top 10 businesses compared to your top 50, the market cap has come off. So basically, this is a similar scenario contrary to that of the US, right? Where you see the top 10 in the US contribute to nearly 35-40% of the total market. And here in India, that number has been coming off drastically, but there the number has been going up, right? So it's continuously only going up. So here you're able to buy the large players also at a cheaper valuation compared to the market, right? So that is more from a valuation perspective. From an inflation perspective, now this is where most of the question comes when we have to think of interest rates and when we have to think of currencies, right? So our inflation has more or less been extremely controlled, right, before the war, right, where we were somewhere below our threshold of 4 plus minus 2. We were on the lower quartile of our threshold. But given how things are now, expectation is that it should go up. I think on 8th they're meeting again, so we will get that number again. But the expectation is that it would go up, but still it would be contained. Right. So the government has built enough shock absorbers this time where we will be able to weather through this phase with lesser volatility. Volatility will be there, but lesser volatility is what we are expecting. Our second confidence point is that we are not having too much of bad loans. So over decades, we have cleaned our entire books. And today we are in a situation that if the government says, let's pull the pump on putting in more money into infrastructure, your banks are in a very good shape to sort of go out and lend that capital. Okay. So from all fronts, we have been protecting and making sure that we're getting better and better. And for whatever phase comes up in the next 1.5 years. So India should definitely be able to capitalize on these opportunities in the future. Okay. Now, in terms of US, now this is one thing. So Neo has that opportunity to take advantage of US. Now, for you sitting outside, when you look at global markets, you have multiple options to choose from. Biggest being US, then you have Europe and UK, then you have your Asian countries, particularly on Korea, and then you have China, and then you have Japan, and then you have a little bit of Taiwan as well. Right. So only two markets today come into those cheap ranges, which is now China first, and then comes India. So these two are markets that are comfortable for non-resident Indians to sort of go and put their capital. But on that side, where you have US and where you have UK and you have Europe, there definitely from a valuation perspective, valuations are extremely high. Even today, if you look at what's happening after the war, it's not reflecting completely the risk that is there in the US markets. Right. There is no, we keep on reading news. If you take up the news, if you just type in, core sector areas that are going to get affected because of this war, a lot of it is still not being reflected into the earnings and the valuation in the US. So there you run that risk. So from that perspective, there is a lot of risk on that side than there is on this side. Right. Despite most of the oil coming here, we do see that shock absorbers are very well present, and that there would be deals that take place between all these big nations. Okay. Now, how long does this war sort of go on for? We've seen this in history that it takes about 6 to 7 months for the entire thing to get okay with, and then another probably 6 to 7 months for stabilization to take place. Now, markets start discounting that stabilization way into that entire 5 to 6 months sort of period. Right? Are we in that period that the markets are discounting sort of recovery? There have been days here where that level of stability and that level of recovery has been starting to price in. But over the last 1 week, after the comments coming in from Trump saying that 2, 3 more weeks is what it's going to go on for, again here there is a lot of pessimism that is coming in terms of global markets and in India. Okay. So time frame that we usually, and you should keep in mind now that you won't get this opportunity again after 6 to 7 months. And if the market starts pricing in recoveries and stabilities way well within that entire range, then that opportunity for you is definitely going to be missed out on. Right. Now, what are we doing to not miss out on such opportunities? So I'll take you through what Neo has been able to do. Okay, Neo's philosophy is very, very simple. We do follow thematic investing, which means we have exposure to very high conviction themes that contribute to GDP growth. Right. And how have we been able to deal with this particular fall? Neo also has volatility, but our volatility has been lesser than that of the Nifty index. And it's much more than the multi-asset index that we benchmark with, about 2 or 3% more. But compared to the Nifty, that covers up. Right. We look at industry leaders. We want to invest more into market leaders that operate in favorable structures, but others at the same time be very conservative in terms of how much we want to pay for these businesses. Okay. We do follow a multi-asset approach. The mandate is extremely flexible. So we are able to shift from asset classes that are overvalued to undervalued. Right. So the entire idea is that we should have a winner in every single market. Right? Because winners of the past need not be winners of the future, and losers of the past need not be losers of the future. Right. So the whole idea is that we should be able to get the best out of each asset class, so that we are able to create and sustain wealth. Okay. So now I'll give you some examples of how we've been able to do this. Okay. Now you look at this. We follow a top-down and a bottom-up research on all asset classes. Right. How do we do that? Let's say we take a thematic idea. Okay. Why don't you give me a thematic idea in the comment section? Let's go with that. I'll not talk too much about the thematic idea. Why don't you give me something? So I'll tell you how we're able to do this in Neo. Okay, very good ideas that are there. Okay, let's look at IT. We do not have any exposure in IT. Okay, so from a thematic idea perspective, that doesn't come here. One. Second, I'll take defense and energy together, and I'll take consumption and finance also together. Okay, so when we look at this thematic idea, for example, when we take finance, we look at it from a top-down and a bottom-up perspective, right? We look at macros to say, okay, is it a good time for us to put money into finance? And which part of finance do we sort of go and put that money in? Do we go put money in banks? Do we go put money in non-banking financials? Do we put money in insurance businesses? Do we go and put money in exchanges? Do we go and put money in AMCs and depositories, right? Or do we look at some fintech businesses that are there? Okay, so first we look at the entire macro picture, then we try and understand where finance and financial services are in the cycle. Are they at that range where they are being overpaid for the book, or they are not being overpaid for the book, and how much is that overvaluation or undervaluation as a percentage? We just look at that. Then from a bottom-up idea perspective, that's where we get deeper. We look at Is it a good time to put money in private banks, or is it a good time to put money in public sector banks? What sort of a mix do we sort of have, right? Then we look at, okay, if we have to look at insurance, do we take everything as a pact or we take only one? If same case for exchanges, same case for AMCs, do we take the entire pact or do we take the one, right? Then that is how we split it into active and passive. So when we look at a passive sort of strategy, we see that, okay, should we take a broader based approach of having a mutual fund or an ETF? For Neo specifically, it is ETFs because it's much more better in terms of compliance and regulation for you. But in Sphere, the other multi-asset strategies that we have, that is also more or less open only for us to put money in mutual funds. Okay, so from a basket approach, we look at which basket to sort of go and investing. Does it make sense for us to put money into the basket? And second, do we look at more active strategies where we're able to buy more businesses and more a single name sort of, or have two or three market leadership sort of names, right? Once we figure out what is the best option, we'll have a mix. Either we will have a complementary strategy where it will be a basket approach, or we will have only one single approach. That is how your active and your passive strategy sort of comes into this entire picture, right? So for consumption, so the two themes that actually Neo is focusing on is financial services and consumption. Financial services, I showed you the chart on how we are coming off from a very bad NPA cycle to a very strong NPA cycle over the last 5 years. And that NPA cycle was pretty brutal in 16, 17, and 18. And now banks are in very solid shape. Our institutions are also again in very, very solid shape. Then you have consumption. India is a consuming nation. Our demographic profile has always shown that we are just getting better and better. And our per capita GDP again is moving from 2,700 to $3,000, and it's actually going to be a lot more. 3,400 odd is sort of projected for 2030. Right. So for us, the expectation is that Indians will start consuming a lot more. Indians have already started to consume a lot more. And the way the pattern in which we go out and consume is going to be a lot more different. So naturally, these consumer companies are going to have a lot more of options to pick and choose from. So will we. Right. So these are two baskets that we are focusing on the equity perspective. Right. So let me give you an example of once we figure out that this is the idea or this is the theme that we want to go and invest in, how do we deploy your capital, right? So we do take some time, we take a staggered approach in and we take a staggered approach out in terms of putting in money, right? So for example, we played the public sector banks from that finance. So it showed us that no, now is a good time for us to invest more on public sector banks than on private because that is cheaper. It took us about 1.5 years to build our position and to build onto that conviction, right? So it's a staggered approach in and it's a staggered approach out, right? In this entire journey, we've taken that decision that we should raise weights also. So it goes from 5 to 6, 6 to 7, 7.5, then to 10, and sometimes it can go to 12.5 also if valuations are very, very cheap. For example, this situation came in June, July of 2022 when the Russia-Ukraine crisis had happened. Okay, so at that point, right, our deployment rate, so for somebody who's just giving us 50 lakhs or giving us 1 crore, 95% of the money was going on that particular day or that particular week because that phase was extremely attractive for us to put capital in. Right. So at that point of time, the mix also, again, because it is a multi-asset, we had a solid mix of equity, direct equity, which is again ETFs and equity both, plus we had a lot of precious metals. Our debt allocation was far more lower. Right. So again, that has evolved and today things stand completely different. So staggered approaches in and staggered approaches out is what we usually follow for Neo. Okay. Yeah. So financialization story, market leadership, consumption as a basket leads to all weather sort of investing. And then again, we are able to capitalize on whatever opportunity comes to us in the next cycle, right? So this flywheel continuously keeps going for us, but the whole thing is based off of this particular think tank. How do we maximize yields, right? We look at top, then we look at bottom, split it, and then automatically start taking in decisions. That's the entire strategy for Neo. Now, how do we manage this level of volatility? This is the worst that we've seen. So this was about 10.7% from a worst perspective. Your Nifty is about 15.8 and your multi-asset is about 8.4. So like I said, it's a little bit more than your multi-asset index, but significantly lower than that of your Nifty. Now, where does this come for investors? This comes between the conservative to moderate risk appetite. So we take risk appetite test for you to try and understand where you stand, and only then this sort of will come to you. we take a basket approach. So the first comment was, is it a good time to invest in Vriddhi, right? So when you come in with capital from your property, right? When you come in with one, two, whatever that, the amount be, generally, we take that basket approach that depending on opportunity, whether to take a one strategy sort of position for you, or do we take multiple sort of strategies position for you, taking into consideration SEBI is minded of 50 lakhs for every strategy. Right. So, based on opportunity, based on what your risk profile is, based on what your goals are, we sit with you, try and understand, what fits for you, and only then go out and suggest it for you. So the return expectations that you should have is average inflation plus 5 to 7%. Okay, this is not a strategy that goes out and does 30 odd percent, so don't have that expectation at all. Despite the past returns showing that, expect average inflation plus 5 to 7% that is sustainable in terms for us to create wealth for you, right? So this is last month's, that is February month's data. This month's data yet to come out, probably will come out today, tomorrow, right? But given that the legacy has been extremely strong since inception, the expectation again should be average inflation plus 5 to 7%. Right. Now, from an overall perspective, how does the fund look like? Now, equity is about 87%. Precious metals again is a small portion. Debt has increased drastically. So again, customization is very, very high for all our strategies put together as a house, because at that time, whatever opportunities are there, we would want to capitalize on it. That is why we take a staggered approach to putting in capital. It takes us about 5 to 6 months to deploy your entire capital that you give us, right? And probably about 1.5 years, depends on how you are able to participate in opportunities. So our team will always come back to telling you that now is a good time for you to put money in India. Now is a good time for you to put money in this particular strategy. It converges to what our desired allocation is for the entire fund. Okay, it would take about 1.5 years for the entire convergence to sort of take place, right? But given how things stand today, equity becomes the priority and the focus, because equity valuations are on the cheaper side, and other assets do have more volatility than your equity. But from an attractive perspective, equity is a lot more attractive than the other asset classes. So we are adding more onto equity. 1 year back, our deployment was going to debt as priority first, and then comes your equity, and then comes precious metals. Okay, so 50 lakhs is a SEBI mandate for this particular strategy, and we are open to invest even in REITs and invest, though we have not taken anything yet, but the opportunity is always available to us. It's a fixed fee strategy of 1.5% per annum, charged on your daily average portfolio value, charged quarterly. Okay, now the team, we have a very strong team, we have a very strong roster. You have Samyukta and Niranjan sir, who are part of Neo and Sphere both together. Shyam sir is the CIO and the fund manager, and he has about 30 years of investing experience. So a lot of it comes on, and a lot of it is shown in how we are able to manage and how we are able to deliver it. No, thank you so much for spending time with us. Just take a note of this number and reach out to this number for any queries that you have, or if you want to take conversations forward. Just send us a hi telling that you attended this webinar and you want to take things forward, or you have the such and such query. And if there are further, if I've made a mistake in communicating certain queries to you and you want some amount of clarification, please do put a message to the team also, and the team will be there to address that particular query. Done. Thank you so much for joining in. Have a great weekend. Thank you.